Welcome, everyone. I'm Joe Galvin, Chief Research Officer at Vistage Worldwide. I'm happy to host the latest webinar in our Peak Performer series. This series is designed to support your leadership climb by bringing the most trusted experts to the Vistage community who provide exceptional insight and best practices to help you navigate new challenges and possibilities. Today's focus is on employee stock ownership plans, or ESOPs for short. An ESOP can help provide a solution to one of the most difficult challenges that businesses face, aligning the goals and incentives of the employees with those of the company, the owner, and the management team. Many leaders think of an ESOP as a tax-efficient exit strategy for a business owner, but an ESOP can do so much more. It can help enhance corporate culture, foster an atmosphere of engagement, and reward hardworking employees with an additional retirement benefit. It can also be a powerful tool for recruiting and retaining talent. We've invited Keith Apton and Nick Francia, managing directors at the Capital ESOP Group at UBS Wealth Management, to discuss the various ways an ESOP can benefit the owner, employees, and the company itself. They'll also dive deeper into what the qualities in a company and owner make for a good ESOP candidate. They'll provide an overview of the ESOP transaction process and outline the role of the ESOP trustee. In today's rapidly expanding economy, and with 66% of CEOs increasing hiring, employee retention and recruiting is so critical. I'm excited to learn from these two experts. Keith and Nick, let's get started.
Thank you, Joe, and thank you everyone for participating in today's webinar. I'll say good afternoon or good morning, depending on where you're dialing in from. We appreciate you taking an hour with us out of this beautiful Friday. I'm actually here about an hour north of Knoxville, Tennessee today in an Airbnb. My wife was a phenomenal sport over the last 15 months, helping raise our two sons in Connecticut while her family was down here in Tennessee. And so we decided to spend a week here just so that she could spend more time with her family. So looking forward to the weekend. Hope you all are as well. We want to make today productive. We want to make it interactive. We want to make sure that you get the most out of today's time with us. So we're going to go over a quick agenda, but just briefly to introduce ourselves, Keith and I run the Capital ESOP Group for UBS nationally. We manage a 10-person team. We have offices in New York and in Washington, D.C., and our entire practice is dedicated to working with entrepreneurs and business owners on different ways to transition a business. One of those ways, which certainly, as Joe put it, aligns the interests of employees and of the owners, is through an ESOP. So today we're really going to dive into that. The first thing that we're going to talk about are ESOPs at a glance, certainly hone in on what an ESOP is, try to break it down and really understand the fundamentals. The second thing is rewarding key employees, or excuse me, not just the key employees, but rewarding all employees. It's been a tough year, 14, 15 months for a lot of people, and how can you really show the appreciation, really reward people for all the hard work that they've put in through this difficult time? Certainly talking about impacting corporate culture, how the positive impact of an ESOP can increase corporate culture and then certainly lead to increased cash flow and profitability long term. And then last, certainly not least, how ESOPs can help improve the bottom line. How structuring an ESOP, whether it's a partial or 100%, can certainly increase cash flow and the solvency and longevity of a privately held business. All right, so let's dive in. What is an ESOP? First and foremost, let's forget the acronym. The acronym ESOP actually stands for two different things. It stands for employee stock option plans, and it stands for employee stock ownership plans. So a lot of times it can be confusing. Today, in the context of this conversation, we're going to be talking about an ESOP as an employee stock ownership plan. And we'll break it down and say that it is a flexible, tax-efficient exit strategy. And the flexibility of an ESOP comes from the fact that you are creating a buyer. So an ESOP actually purchases the stock from the business owner. It owns the stock. It's a legal shareholder. And so because you're creating the buyer, the flexibility of an ESOP comes from the fact that you can sell a portion or all of your stock. And as all of you know, every business is different. Every business owner is different. And your goals and objectives in a transition strategy are all going to look different. So for a partial sale, you can sell 20%, 30%, 40%. For 100% sale, you could certainly do that as well. But it's going to come down to the goals and objectives. The second component to an ESOP is the tax efficiency. There's tax efficiencies at the corporate level, which Keith is going to dive into later. And there's tax efficiencies at the individual level. And very simply put, an individual can sell stock to an ESOP and permanently avoid the capital gains tax in connection with the sale. Under current tax law, and I say current because as everyone I'm sure has read or seen on the news, there's a lot of proposed tax law changes, especially with capital gains going from 20% today at the federal level to something closer to potentially 28 or 30%. All of that's up in the air, but one thing's for certain, we do think capital gains taxes will go up. So that's an important characteristic. And the last thing, it's an exit strategy. An ESOP is not a quick transaction. And we'll talk about how this compares to other types of exit strategies like selling to private equity, like selling to a strategic. What are the pros and cons? What should you be looking out for? What do you want to understand? But an ESOP's not a quick exit. It certainly takes time. It certainly is a 5 to 7 year plan. But if it is used properly, it is an extremely powerful succession tool, not only for the owners, but for the employees and for the company.
Nick, on the comment about flexibility, you had touched upon about selling a minority interest, selling as little as 20%, 30%, 40%. To take that a little bit further on the flexibility, we see individuals looking at ESOPs where they could sell 100% of the stock or do a minority stock sale, like Nick said, where maybe you own 100% of the shares and you just want diversification and you'll sell 30% today, so you have some liquidity. You maintain full control of the company, and you can obviously sell the remaining 70% in the open market or to the ESOP in the future. But where that flexibility in a minority stock sale also comes into play, for many of you, you own a company with multiple shareholders. And we've often found an ESOP is a great solution when you have a divergence of interest or a divergence of ages amongst the shareholders that own a privately held business. So if you have a company with 5 owners or with 4 owners, and maybe 2 want to leave in the case of 5 and 3 want to stay, or if you have 4 owners and 2 want to leave and 2 want to stay, it can be difficult. Obviously there's buy-sell agreements, but it could be a difficult situation of some want out and some want to stay. And that's where that flexibility in the minority stock sale has really come into play in our communication with clients of, do you know all of your options? Maybe this ESOP with the flexibility can allow you to sell 40% of the outstanding shares, so the 2 that want to leave can get out, the 3 that want to stay can stay. They're not diluted at all, and it becomes a win-win for all parties involved.
Keith, can I jump in and ask a question, please?
Please.
Yeah. Would this be what you just described? Would that be an applicable solution for a family-owned business where there's 3 or 4 owners from grandpa to dads to now kids and wanted to figure out what to do? Have you seen a situation where that's been a viable solution for them?
Yeah, we've not only seen it, Joe, in a family-owned business in your scenario where you have cousins, right? You have cousins and siblings from two siblings started a business. They each had kids. The kids are, within the same family, but they have their own families. And some want out and some want to stay, and they want to remain a family-owned business. Perfect example of using a minority stock sale of an ESOP where some family members can sell.
Great, thank you.
To expand upon that, Joe, we've also seen clients of ours with family-owned businesses where I call it the tug of war. The matriarch says, I want to sell to have liquidity to retire, but my daughter is involved in the business or my son is involved in the business, and I want he or she to have the same benefits that I've had as a president or CEO of a company to continue to run it. So in that scenario, we've seen individuals where they'll take this private family-owned business, they'll sell 30 to 49% of the stock to the ESOP. They have their liquidity, so mom and dad are secure financially for retirement. And then ultimately the kids, through gifting, can maintain control of the company outside of the ESOP because the parents can gift the remaining, call it 50, 60% of their shares to their children, who can ultimately stay on board and control the board of directors and run the company moving forward. So it's a great solution within a family-owned business.
And let me just tie that back into actually why this is applicable with an ESOP and it's not in most other types of exits, because it's important to note when you're looking at different types of exit strategies, you can sell to private equity, you can sell to a strategic, you can sell to an ESOP, you can do a dividend recap, you could do a management buyout, you can go public. There's so much flexibility in the different types of exit strategies that you can look at. But the difference with the ESOP is the fact that you are creating the buyer. And because you're creating that buyer, that's what is allowing you to sell a minority stake in the business. Whereas with private equity or with a strategic buyer, the majority and the strong majority of the time, private equity is not going to want to take a minority stake in the business. They're going to want 100%, or they're going to want control. Same thing with a strategic buyer. So that's what affords the ESOP the luxury of being able to buy a minority stake and giving you that flexibility as the shareholder. What it also does, if we go to the next slide, we'll talk a little bit about the employee benefit here. Because as
before we go, Nick, I'm sorry, but a question came in and now I understand it.
Yeah,
can you address how an ESOP might affect certification as a diverse business? So as long as the majority ownership is diverse, how does that play out? That just came in, so I wanted to.
I'm going to assume that what you're alluding to is minority-owned, women-owned, veteran-owned business.
That was my assumption also.
Okay, I will answer it under that assumption, and if the question comes back and somebody says that's not what they meant, we'll address it a different way. There's different provisions. So women-owned businesses it's a little bit more lenient in terms of the way that the ownership structure works. Veteran and minority-owned don't have the same leniency, but for the general population of those three, we see a tremendous amount of ESOPs in those sectors, because what it allows for, if you think about the business today, let's say it is a women-owned business today. You have your set-aside work, you have your contracts, and you look to sell this business. If you sell it and you're going to lose status through that sale, you're probably going to lose a tremendous amount of value in the process, because the buyer is no longer going to get the same level of contracts. However, if you can sell to an ESOP and you could do a partial sale, you could sell 49% of the stock to the ESOP today. You can monetize that value. You could take that equity out of the business, capital gains tax-free, and continue to run the business as a 51% shareholder. As you're running the business as a 51% shareholder, you're still retaining status, whether it's women, veteran, minority owned. And so you continue to run the business from that perspective. 5 years down the road, 3 years down the road, 7 years down the road, however long you want to say, you continue to run the business. You then have the flexibility to sell the remaining stock to the ESOP. And when you do that second stage transaction, that other 51%, you do lose status, but you've taken the first bite at the apple. Now during that second bite, you're losing the status. However, what we haven't talked about yet is if you're a 100% ESOP owned company, taxed as an S corporation, the corporation operates federally and most state income tax free. So the tug of war, to use Keith's words here, is even by losing status, are you continuing to have the same level of free cash flow because the company's no longer paying taxes, as opposed to keeping the status and having to pay taxes? So that's the analysis, or that's the conversation that we're having with a lot of our clients that are in those three categories. Jumping in then here to the slide, talking about rewarding employees. I think Keith did a really nice job of explaining this a minute ago in terms of the minority stock sale, because if you look at selling 30%, 40% of the outstanding stock to the ESOP, not only are you as the business owner using it as a diversification tool, not only are you able to monetize part of the business today, but that equity value in the 30% that you sell to the ESOP now over time is getting transitioned to all of your employees. So now all of your employees are economic beneficiaries of the ESOP trust that was created. And over time, they're going to start receiving that benefit. And as they receive that benefit, not only is it an employee retention tool, but it's an employee benefit. The employees are not taking any money out of their own pocket to purchase this stock or to participate in the ESOP. What they're doing is they are showing up to work every day, and just because they're on payroll, just because they are part of the salary or receiving a salary in connection with the company, they're receiving shares. And those shares have value, they accumulate that value, and then over time, they start to see a very significant benefit. We've already talked a little bit about culture. But obviously, if you think about it in general terms, as the company continues to remain profitable and as the benefit continues throughout all the employees, the culture is just automatically going to increase. There's an increased level of culture because the employees feel that they are really part of the overall profitability and the growth of this business. And then aligning the goals. Moving on to the next slide, Keith, do you want to talk a little bit about why, as a business owner, you'd consider this? We've touched on it, but maybe dive in a little bit deeper.
Sure. So Nick just briefly touched upon being able to sell capital gains tax-free. I think to expand upon that, the way to look at that is it's not tax-free, it's tax-deferred under the current code. What Nick is having regular conversations with right now on behalf of our clients and prospects is the desire to sell stock and defer paying the capital gains tax in a manner under Section 1042. And so what that means is, if you sell stock to the ESOP under certain provisions, the company has to be a C-Corp, and we're not really worried about that. The majority of the companies that end up doing 1042 start off as S and they go to C, and then they can wait 5 years to go back to the S. But there's sections of the Internal Revenue Code that go back to 1986 that say, with certain limitations, you can sell stock to an ESOP so long as the ESOP owns at least 30% of the outstanding shares at the time of the sale. And the company at the time of the sale is a C-Corp. And as I said, you could be an LLC today, you could be an S today prior to the sale, but ultimately we would work with lawyers to reincorporate you to make you a C-Corp to sell. And that would add tremendous benefit to you economically, because it would allow you to elect Section 1042 and defer paying the capital gains tax. It works very much like a Section 1031 in real estate. So if you think about that, if you're under the mindset that we are, that capital gains are going up, that's going to allow you to avoid paying the capital gains tax on the sale of your business at the federal level, and most states follow as well. So you have the 3.8% Medicare surtax, you have the state tax, you have the federal tax. So at a very high level, if we were taking the broad averages of where state taxes are, that's a 30% savings to you as a business owner.
Hey, Keith, can I jump in? Because this is a question that came in before, but you were talking about C-Corp and S-Corp. And I want to make sure we answer this. We are a C-Corp with one shareholder. Do we need to be an S-Corp to set up an ESOP?
No, to do an ESOP, and there's pros and cons. That's why if there's anything Nick and I share with clients of ours that are contemplating how to sell, make sure you know all of your available strategies and make sure you know the right time to sell. Very important. When should you sell and how should you sell? And as Nick said earlier, and Joe, I'm going to come back to your question specifically on the S&C. There's so many different ways. If you're going to choose an ESOP over a sale to a third party, you should be able to tell your deal team and your family and your board why you're choosing the ESOP. Conversely, if you choose to sell to a third party over an ESOP, you should be able to say, I'm choosing a third party over an ESOP for this reason. Where I'm going with that is, you need to have modeling. You need to have information, because with information, you have power to make the right decisions for yourself. With that, even within the ESOP, Joe, there's so many different ways to structure it. You can do the partial sale, you can do the 100% sale. You can sell stock as a C-Corp, or you can sell stock as an S-Corp. And the C-Corp ESOP sale is vastly different than the S-Corp stock sale. So we would never go into a conversation with a client and assume that they don't want to pay the capital gains tax and tell them they should dissolve the S and go C, because there's reasons to say S. Conversely, there's some clients that want to go 100% S right out of the gate instead of be the C, because they have very high basis, and being an S-Corp allows the company to operate tax exempt. So the answer to that, Joe, is you can be a C, you can be an S to do an ESOP, you cannot be an LLC. So prior to the sale, you're going to have to decide, is it better to be a C, is it better to be an S? And the last thing I'll leave you with is, you don't have to overthink it. Because if you start off as a C, there's strategies to have you benefit as a C-Corp seller, where you don't pay the capital gains tax, and then we can flip you back to an S-Corp with the right tax planning, working with your CPAs and counsel, where you get the best of all worlds, whereas the seller, you can avoid paying the capital gains tax, and the company can start to operate tax exempt. if you're a 100% wholly owned S-Corp. So a lot of flexibility there. So I touched upon earlier that going back to 1986, there's a provision in the Internal Revenue Code. It works very much like a 1031 in real estate. We can spend more time on that later, but it allows you as an owner of a company to have the power of deferring paying the tax. Clearly, if you defer a tax, you have more money, you have more dollars that are productively working for you in your portfolio or whatever you choose to do with the liquidity out of the transaction. Moving down, you continue to lead and participate in the management of the company after the sale. I'm careful when I say this, if you want to. There's some owners, many of you are passively involved in your company. You've put in a management team. Don't take that comment as after you sell stock to an ESOP, you have to remain active in the company. What we're saying there is you have the beauty of being able to negotiate this transaction with the trustee on behalf of the ESOP to make the decision as to how active you want to remain involved in the company, how long you want to remain on the board of the company. The buyer of the company, which is the trustee, they're looking to do what's in the best interest of the plan participants, which are your employees. So if you as the owner are instrumental to the growth and the profitability of the business today, the trustee would love for you to stay on board, because that's the best way that they can assure themselves that they're buying a business and there's not going to be this immediate fall off of earnings and revenue. They want this company to succeed for the benefit of the plan participants who they are the trustee on behalf of. So you as a seller get to kind of decide, when do you want to phase out into that next chapter of your life where you really don't have that control when you sell to a third party. When you sell to a third party, they typically want to recapture your W-2 and your salary as quickly as they can to cut costs and increase their profitability as a buyer. Moving to the third and the fourth areas here of why I consider an ESOP. ESOPs can help reward employees and management, which in turn increase productivity. It really does align everybody. If you're an employee or if you're the management team of an employee-owned company or an ESOP, you are benefiting from a rising stock price. As an employee, you have an economic interest now in the company that you haven't bought. As an employee, if you don't work for an ESOP, you go to work, you contribute to a 401k, you collect a paycheck. As an employee, if you go to work for an ESOP, you go to work, you collect a paycheck, you can continue to contribute to your 401k, and you're getting free stock inside this ESOP so long as you're an eligible plan participant. That's a big disconnect in the community, that business owners think the employees are buying the stock. They're not buying the stock. The employees are economic beneficiaries of having a financial interest inside the ESOP in the future. Yes, Joe.
Joe,
couple questions that came in, one that's pretty straightforward and one that's rather detailed. What's the minimum number of employees needed to efficiently implement an ESOP?
It's a good question, Joe. I always try to move away from this, and it's probably best if Nick and I say this now. I mean, clearly we cannot give tax or legal advice. We work for a bank, so we'll say that. But I'm always very careful to say minimums. It's an opinion. What's the minimum ESOP size? That's an opinion. What's the minimum amount of employees? That's an opinion. Now, I've been in this business for 20 years. Both Nick and I sit on the finance committee, so I'm very confident in my opinion. What I would say is, my sister owns a company. If my sister called me and said, Keith, I want to do an ESOP, when would I grow comfortable advising my own sister to look into an ESOP? And if I'm not going to do it for her, I'm certainly, Joe, not going to do it for a client. And so the answer is, in my humble opinion, I don't think companies should look at doing ESOP transactions unless they have a minimum of 20 employees. And really, Nick and I are moving that closer to 30. And the reason I say 30 is, with 30 employees, you're fairly safe that the math is going to work, where the company is not going to fail for various testing methods that the TPA will do. With 20 employees, it gets a little hairy. So what we say is, if it's fewer than 20, but more than 20, fewer than 30, but more than 20, let's take a hard look. If it's more than 30, we're not concerned. If it's fewer than 20, we might be forcing a deal that probably shouldn't happen. That's my opinion.
Okay, well, let me ask a more detailed question, because I think it raises a good point. This is from one of the folks on right now. We are deep into learning, consideration, and modeling of an ESOP. One recent learning is that in a majority or 100% sale, that a trustee must consider an offer to purchase the company by an outside entity. The trustee is bound to consider and prioritize what is best for the employees' shareholders. A large competitor could, if they so choose, approach a trustee with an offer that can't be refused. feels like the risk of the equivalent of a hostile takeover, which would completely undo the goals of an independent internal employee owned. Can you talk about this risk of acquisition and what it might mean?
I think the question is, simply put, can you do an ESOP and assure yourself that the company will always remain an ESOP, if I understand the question properly? And unfortunately, I don't think the answer to that is yes. You can have the intention of selling your stock to an ESOP. Your intention can be to make sure that you're giving back to your employees. But to the spirit of the question, if you're a trustee and you're looking out for the best interest of your plan participants, and an offer comes in, Joe, and the offer is 2x the value of the company to be dramatic, that trustee, in all likelihood, is bound in that scenario as a fiduciary to make a decision that's in the best interest of the employees. And if you have somebody that's paying 2x the value of a company, that's a pretty good situation for the employees. Now, what I would say there, if the individual that was asking the question was a private client of ours, would be, that's actually a pretty good thing for your employees, though. And I know the goal may have been to preserve this ESOP, but if you sell your stock to an ESOP and you've exited, that means you've sold stock at presumably fair market value and you've secured your retirement. And from an altruistic standpoint, you may have set this plan in place to reward your employees and take care of them. Well, if this company is being sold to a strategic buyer at a premium, your employees are then getting a big paycheck. Instead of them waiting to vest and waiting to receive the money when they retire, Joe, in that scenario, a strategic buyer comes in, they buy the company, the proceeds go to the ESOP distributes it immediately to the plan participants or the employees, which theoretically should be aligned with the owner's goals, because now the employees have liquidity and they've received money at no cost, no obligation as a distribution from the ESOP. Nick, would you add anything there or say anything differently?
No, I think that's exactly right. I think it just comes down to the common misconception that ESOPs being acquired is a negative. And I think that you did a great job of explaining why it's actually a windfall of cash and a windfall of value to the employees. So, we'll get into this in a minute, but, not every thing about it, ESOPs is going to be perfect. And if you want the ESOP to remain in place in perpetuity or forever, it's not a guarantee. So it's something that definitely needs to be considered as you look at all your options.
Moving on, just before we go to the next slide, just the last thing I said there is it preserves your legacy. If as an owner, the last thing you want to do is go to the grocery store and see some of your employees looking at you saying, you sold this business, I worked for you 20 years, you got a nice check from private equity, and private equity came in there and did a riff right away. Your name stays on the front door in all likelihood when you do an ESOP. Very rarely do we see the board or the employees, vote to and the employees don't vote, it'd be the board. Very rarely do you see the board change the name on the front door. It's quite the opposite. It preserves your legacy because you're taking care of your community. You're taking care of your employees. And ultimately they come to thank you when they see you, because they start to understand that there's a meaningful difference in their retirement plan if properly communicated. I wish I could say that that's always the case. It's not. Unfortunately, a lot of ESOPs are put together where the team of advisors focus solely on the entrepreneur that's selling. Everybody gets paid, the professionals collect their fees, they walk away, and the board of directors and employees never get the proper education as to how an ESOP actually works. There's costs, there's complexity, and it takes time to create this real meaningful value for the employees. It doesn't happen overnight. So it's very important, I want to stress that you hire competent individuals in their respective lanes. There's many lanes in an ESOP transaction. And one of the most overlooked areas is individuals that actually provide the proper education to the management team and the board as to, what it means to have an ESOP and what the ongoing compliance would look like moving forward. Why don't we move on in the spirit of time to the next slide?
Sure.
I'm sorry, Nick.
I was going to say, Keith, I think that in terms of understanding the cash flow of how the ESOP works, it's an important time to articulate that, because we're talking about the ESOP being a buyer, we're talking about the cash that's going to come from it, the economic benefit to the employees. But let me just take a second to explain the cash flow of how an ESOP actually works, where the money comes from, right? Because the money is actually what makes this whole thing go round. So let's just use $10 million as an enterprise value for illustrative purposes. if Keith runs a $10 million company and he's looking to sell and he's exploring an ESOP, well, we all know that although altruistic people may work at banks, banks are not altruistic. Banks want to make money by lending money to companies. So that $10 million company has the ability to take on debt from a commercial lender. So a commercial lender is going to look at the balance sheet of the company. They're going to look at accounts receivable. They're going to look at cash flow. They're going to look at projections, and they're going to say, I'm willing to lend that $10 million company $5 million. So the commercial lender lends the company $5 million. That's the first step. The second step is the company then takes that $5 million and the company lends it to the ESOP. So now the ESOP, which is nothing more than a tax-exempt trust that was created for the benefit of the employees, now has $5 million of cash in it. Now Keith, as our owner in this example, has a decision to make. How much stock does he want to sell? Let's say Keith is looking at an ESOP as a way to reward employees, a way to diversify his net worth, a way to take some money out of the company, capital gains tax-free. He decides he wants to sell 49.9% of the company. So Keith sells 49% of the company to the ESOP. The ESOP gives Keith the $5 million of cash. So now what do we have? That's an M&A transaction. Keith is the seller, the ESOP's the buyer. Keith received his $5 million of proceeds or consideration for half the value of his business. So one day after the transaction, Keith has $5 million of cash sitting in a checking account. Keith still owns 51% of the equity in the company. And the company owes the commercial lender $5 million. So now through the profitability of the company, through the cash flow, the commercial lender is going to pay, the company's going to pay the commercial lender back that $5 million. Just like if you took on debt today, same concept. Now the key, and the reason we're all here today, is to talk about how the employees benefit from that transaction. So as that debt is being retired, as that $5 million is being removed from the company's balance sheet, every year, the employees are going to receive an allocation of stock. So if there's 30 employees at the company, those 30 employees are all going to have their own ESOP account. Very similar to if you had a profit sharing or a 401k plan, they're each going to have their own account. And the way that they get shares is they get shares as a direct correlation to payroll. So if somebody makes $100,000 and another individual makes $50,000, the person that makes $100,000 is going to get double the amount of stock as the person that makes $50,000. But every single year, as the 49% of the stock is sitting in that ESOP trust, in that ESOP suspense account, it's being distributed to each one of the employees as a direct correlation to payroll. So every year the employees get a statement. Every year the employees see the value of the shares of stock that they hold in their ESOP account. But I want to be very clear, even though they are having an economic value, even though there's an economic benefit, they're not owners. They're economic beneficiaries of the trust. So they're not making decisions at the board level. They're not choosing what their salary is. They don't get to choose how many days off they get every year. The company's still operating, again, in this example, as a partial ESOP. So Keith is still 51% shareholder. He still has complete control over the company, but the employees are the economic beneficiaries now of 49% of the company. So I just thought it was important, 30 minutes into this, we're talking a lot about the concepts of an ESOP, but I wanted to make sure that we pause to actually understand, where does the money come from? What is the money flow? All right, getting back into the slides. We've talked a little bit about this, ESOPs being an alignment of interests. We talked about the owner. I think that we've exhausted that. The employees is what I just addressed. Management is something we haven't necessarily talked about. Obviously, management is part of your employee base, so they are going to be economic beneficiaries as well. But what we find a lot in ESOP transactions is the management team sometimes can say, Keith, Nick, I appreciate this economic benefit, but I've been with the company for 15 years. I've been side by side with this owner from day one. And I understand that this person just started last year and they're now going to start in the ESOP at the exact same time I am. And even though I'm more highly compensated, I'll get more shares, but it just doesn't seem right. It doesn't seem fair that we're both getting into the ESOP at the same time. And as an owner, I'm sure that you can appreciate that. You're empathetic to your key management, right? That they've been with you from day one. So what happens a lot of times is in connection with the ESOP, at the same time, owners will add a non-qualified plan. Non-qualified just meaning stock options. So they'll add a stock option plan at the same time they add the ESOP plan. And because an ESOP is a qualified plan, you cannot discriminate as to who gets shares. But with a non-qualified plan, you can discriminate. So you can choose who your key executives are, who your key employees or key management team is, and you can give them stock options in excess of the ESOP shares that they're going to get to truly incentivize them and really give them the golden handcuffs to make sure that they continue to stay on with the company and see the success of the company through. We've talked about the company, how it can potentially reduce tax liability. This is obviously, taxes are on the forefront of everyone's mind only because there's so many changes coming down the pike. But as we said earlier, if you're 100% owned by the ESOP, taxed as an SCorp, you operate federally and most state income tax free. If you are a CCorp and you end up being a CCorp for a period of time as an ESOP, there are still significant tax benefits at the corporate level. Not going to be as tax efficient as the SCorp route, but still tax efficient. Keith, let's get into rewarding employees if you want to take the next couple slides.
Sorry, I was on mute there. So the rewarding the employees, it's clearly going to enhance the culture of a company. The employees, as I mentioned earlier, are going to still be able to contribute to the 401k plan, but an ESOP is a retirement plan rewarding employees for their loyalty. It's an additional benefit that this employee has if they stick with the company for a period of vesting and they retire from the company, or they're fired from the company, or death or disability, any form of termination governed by ERISA. There will be a distribution from the ESOP for any of their shares that were vested at that point in time. It allows employees to obviously have a stake or participation in the future growth of the company. There's a lot of studies done. There's several nonprofits in the ESOP community. There's the ESOP Association. There's the National Center of Employee Ownership. There's a third nonprofit called ESCA, which is for S Corporation ESOPs. And all the data will show you, if you go back 20 plus years, that employee-owned companies are far more productive than non-employee-owned companies, typically sector by sector. And it's really because you are changing the culture of the company. We've talked about the employees not paying the shares. And the last bullet here is the employees are getting something and they're not paying a tax for it. It's not like phantom stock or something of that nature. What happens is the employees are being given shares in a retirement plan. The growth of those shares, it's just like money that's growing in a 401k plan, is not taxed to the employee until the time that they actually leave the company. When they leave the company, there's a distribution. And just like a 401k at that point, all of the growth for the employee has been tax deferred. The distribution comes out of the retirement plan, which is the ESOP, to the employee, and the employee has a choice to make. At that point in time, the employee can either pay a tax, just as they would with a 401k, or just like a 401k, they can do a rollover into an IRA, which is another form of a retirement plan. So we're giving the power to the employee to defer the tax for their participation in the company or the ESOP. And then when they leave the company, they can either roll it into an IRA or at that point in time, reduce part of the windfall that they're coming into in the form of paying a tax at that point in time. Next slide. Talked about rolling it into, I would say, Nick, let's roll past this because we spent a lot of time on that, and I know we have limited time left. Impacting corporate culture. This is really where we get excited about it. ESOPs directly benefit, in my opinion, all three parties. I think you have a situation where the owner benefits because the owner is in control of how long they want to stay with the company. The owner can be compensated for all additional growth of a business, because if an owner sells 100% of their stock, they're not going to get all cash at close. So they'll oftentimes carry back a seller note. That seller note can carry with it an equity interest back in their company in the form of a detachable warrant. So you have a situation where with an ESOP, if the company continues to grow, the selling shareholder is winning, the employees are winning, because the employees now are getting free equity inside of a retirement plan, and that equity is growing if the business performs well. And then you also have a situation where the management team, as Nick was mentioning, they're going to benefit as well. The management team is really incentivized with a properly designed ESOP to grow the company, because not only are they a plan participant, as Nick mentioned on the prior point that he was referencing, but the management team is going to get additional equity if you put synthetic equity coupled with an ESOP in the form of stock appreciation rights in the future growth. So a very common feature is management will participate in ESOP, and then management will be aligned with the company, with the employees, and with the seller to grow the business, because they can oftentimes get anywhere between 15 to 20% of all future growth outside of the ESOP. So management, employees, company, and seller are all aligned, which really enhances the corporate culture. Next slide. Impacting the corporate culture here. Employees may earn higher incomes and have a higher household wealth than non-employee owned companies. If anybody is interested in that, we do have a couple white papers that we can circulate. One of them is really neat. It really speaks to the average value of an employee's account inside of an ESOP that's an SCorp versus the returns of the S&P 500. And it's pretty powerful. It shows you that the average employee that's leaving a company after being there for an extended period of time has far more wealth that's created for retirement than an employee that's just going to work for a non-employee owned company. We have white papers that we could circulate for anybody that's interested in that. That second bullet point is just speaking to that. There's ESOP participants may have up to 2.5 times the amount of retirement assets held by non-employee owned ESOPs in comparable businesses. Next slide. Nick, go ahead and turn this one over to you.
Yeah, absolutely. So this is really the motivation factor, right? Employees as often as we want to talk about it, you know, as executives of a company or as owners of a company, we're always looking to find ways to motivate our employees, have our employees show up and want to be there and want to put forth their best effort, want to make sure that the work that they're doing is quality, it's on time, it's correct. So these studies just speak to the fact that when there's an economic incentive, right? When you have employees, and there's this terminology of employee owners that's always thrown around, but when you have employees that actually feel that what they're doing every single day is then translating to the bottom line, and then the bottom line is ultimately translating to value, and value is then translating to what's in their ESOP account, there's an immediate feeling or sense of self-worth that's not there in a non-ESOP owned company. And so all the studies that have been done is whether it's a partial ESOP or 100%, because you get the same feeling from a partial ESOP. These employees certainly not only hold themselves more accountable, but they hold each other more accountable. And there's great stories that I've heard about trucking companies or manufacturing companies where you have, you know, one employee calling out another employee for not doing something because, you know, in a non-ESOP owned company, it didn't impact them. It only impacted, you know, the owner, but here it impacts them. So what that means or what that means to them in particular is they're holding each other accountable. They're working harder. They're more focused on the bottom line. All things that are going to represent a mutual alignment of interest, as Keith said earlier, between the company, the employees, and the owner or selling shareholder as they transition out. Go to the next slide. All right. Can ESOPs help improve the bottom line? You know, I think pictures say 1,000 words. This is, you know, this is a graph that Keith just alluded to about the difference in the S&P 500 and an SCorp ESOP, rates of return, and what it means to a participant. And as you can see, and remember, this is their retirement accounts. So this is not, ESOPs are not meant to be a get rich quick type of strategy. So what happens is there's a vesting schedule. And that vesting schedule is either going to be a 3-year cliff vesting schedule or a 6-year graded vesting schedule. 3-year cliff simply meaning You're not vested for the first 3 years. You're 100% vested starting in year 4. 6-year graded, meaning 20% per year starting in year 2. So first and foremost, these employees have to vest. Their shares have to become vested. And then once their shares become vested, yes, employees can leave, and yes, employees can put the stock back to the company, but it's really not going to be significant until they've been with the company for multiple years and they've started to accumulate that stock. But if they're with the company for a long period of time, what we're seeing is the value of this stock is exponential. And it's partially because of company performance, but it's also because of the tax benefits at the corporate level. Meaning, if you look at the value of a company that's taxed as an S-Corp with an individual as an owner, where all the profits flow through and the individual has to pay tax on their own individual tax return, compared to a company that's 100% owned by an ESOP and is operating federally and state tax-free, you're immediately going to see more benefit. You're immediately going to see a higher value. You're going to be able to go out and make acquisitions. You're going to be able to go out and invest into research and development. You're going to be able to invest into your people. It's going to be easier for you to grow as a company, and we're seeing that in the numbers.
What this chart is showing you, simply put, is the wealth in America is created in your businesses. Your business owners, you are creating far more wealth for yourself every year running your company than you are investing in the market. Now, there's years where the market does extremely well, but by and large, we know the wealth is held in privately held businesses. This chart speaks to it. It shows you if you had invested $20,000 in the S&P 500 between 2002 and 2012 versus, as I mentioned earlier, the National Center for Employee Ownership. They do a great job pulling census data from S Corporation ESOPs. This shows all the S Corporation ESOPs where they could pull the valuations over a 10-year period of time. And you can see your businesses as a business owner outperform the stock market. That's why everybody is focused on your segment. That's why you've taken risks to be an entrepreneur. This obviously speaks to, instead of you benefiting from being your owner, being the owner of your company, your employees stand to benefit. And typically the performance of the actual ESOP itself on a forward-looking basis is going to outperform the assets they have inside their 401k. We just graphically are illustrating that here. Next slide. ESOPs here can improve the bottom line. Joe, I'm going to kind of pivot here only because the next couple slides here start to be a little bit redundant in relation to taking the time to go through some case studies or going through some things that are applicable. I know that we have about 10 minutes left, and for me, I really want to make sure that we're able to go through some real life scenarios as to where the ESOP was used as utility and where it makes sense. So I'm going to kick it back over to you to ask any questions.
Great, thank you, Keith. This has been incredibly informative, and I'm glad you stopped here because we've got a number of questions that come in live. But one question that's foundational to all this is cost, right? How much does it cost to set up an ESOP? How does the plan administration cost annually? What do you cost to keep it going? Talk a little bit about cost, please. And I kind of know what the answer is before I ask it, but go ahead.
Yeah, there's two different ways that the Vistage members need to ask that. There's the cost to establish an ESOP, and then there's the ongoing cost for the compliance and the maintenance. And unfortunately, there's no simple answer. We're not going to avoid the answer, but to give the answer that you deserve as a business owner looking into this, it depends on what you're looking to do. It depends on the complexity. It depends on the size of your company. It depends if you're doing a 100% sale. It depends if you're doing a partial sale. It depends if you're going to have bank financing or selling financing. So let me not give you an answer of it depends. That is a real answer. And let me take the time to have you understand there's different lanes and different roles in doing an ESOP. So anytime that you're looking into doing this, whoever you hire to be your quarterback to put it together, the way to ask is not what are you charging me? What is it going to cost me to get a deal done? Typically on the sell side, representing the business owner to sell the company, there's going to be fees to a financial advisor. I don't mean wealth advisor, I mean investment banker. And that investment banker is going to raise capital. They're going to negotiate with the trustee. They're going to run and manage the budget and the timeline. That's called the sell side investment banker. And there's also going to be an ESOP attorney. And that ESOP attorney is going to actually do the legal work to draft and implement the trust. So there's two set of fees on the sell side. On the buy side, which is the buyer, the ESOP is a buyer, the ESOP is going to need its own trustee. That's one. The trustee, which is the buyer, is going to need their own legal representation. So that's a lawyer. And the trustee is going to need a valuation firm to render them a fairness opinion so that they ultimately know what to pay for the stock in the negotiation that they'll have going back and forth with the investment banker representing the seller. So in totality, I've just mentioned 5 professionals. The 6th one, Joe, which is what you asked, is the third-party administrator. Once you implement an ESOP, you have a retirement plan. That retirement plan is going to require a 5,500 to be provided, and that 5,500 is going to pull the data from the valuation and send the employees a plan participant statement each and every year telling them how many shares they have, when they vest, and what the value is. The ongoing cost to your specific question, Joe, for the TPA or the third-party administrator is typically a cost per employee. So depending on how many employees you have, a TPA can charge as little as $2,000 to as much as $10,000. What we see in the market right now is scale. So a company that's doing an ESOP that is worth, if you're a company worth $20 million, so a $20 million enterprise value, the range of fees to do a deal that is about $20 million of size for everybody, I don't mean any one individual, is going to range anywhere between 2% to maybe 3%. That's kind of the range. And it depends on bank financing or not bank financing, partial or 100. On a $100 million ESOP, if you have a company that has an enterprise value of 100 million, the range of fees on that deal for all professionals is going to be anywhere from maybe 90 basis points to 1.25. Scale. The larger the deal, the skinnier and aggregate percentage the fees are going to be. But the way to ask the question is, what is it going to be for all professionals? And then the ongoing cost, Joe. Ongoing.
Can I pause and ask a question then? Because is that why having less than 20 employees makes this not such a good deal?
No, the reason, and I have to be careful here because we can't give tax advice. The reason we say that is Nick and I believe that an owner should not be forced to do a deal under certain structures. You as an owner should have the flexibility to do a CCorp sale or an SCorp sale. If you have fewer than 20 employees, there's a form of testing that becomes complicated called 49P. And if any of you talk to your CPAs, they'll quickly be able to tell you what a 49P is. But there's certain things with testing, Joe, that if you have fewer than 20 employees, become problematic to fail 49P. So it means by default, you as an owner only have one option to do an ESOP. And what it is at a high level is the 409 section says that no one employee should have over 10% of the allocation of the shares inside of a plan. So when you start to get to 12 employees, 13 employees, not everybody's making the same amount of salary. Some employees can actually have more than 10% of the shares. Then the client's set up to fail 409P. And you don't want to force a transaction. You want to make sure that the deal makes sense today and it can continue to make sense in the future.
Got it.
The only other thing I'm going to say is I talked about cost. Ongoing, here's the boogeyman. You talk to ESOP professionals, they don't tell you about the compliance of an ESOP and the cost of an ESOP. An ESOP is a complicated animal. You need to make sure you have a solid, competent team of advisors. You need great counsel. You need proper people that can ultimately have you understand the unintended consequences and blind spots. With an ESOP, Joe, here's the reality. You are ultimately going into a retirement plan that's going to be governed by ERISA, which is a good thing. There are rules that tell you if you're doing the transaction properly, but you have to follow those rules. So you're going to want an outside independent trustee. You don't have a trustee right now. There's going to be more formality. You probably don't have a lot of formality right now. There's going to be real composition of a board. Right now, you might not have that. And you're going to have to get an annual valuation on the company, because that's the only way that you can properly allocate the shares to the employees. So with an ESOP, you're going to have additional costs moving forward. Both Nick and I believe that the tax savings at the corporate level far exceed the cost. If you think about an SCorp ESOP, if you're saving all your money in taxes, that should exceed the ongoing cost of evaluation in a trustee. But just know that going into it. Ask the right question. Develop trust with your deal team. There's additional costs with an ESOP that you don't currently have, and there's certainly additional complexity. And you need to have a really good trustee and really good legal counsel to make sure that you're doing things the right way as intended by the Department of Labor and the IRS.
Great, thank you. Next question. Are there businesses that are more difficult to flip an ESOP, like a restaurant as compared to a bank?
Nick,
Yeah.
I'll let you take that one.
Yeah, absolutely. It's a great question. And, what we didn't talk about today either is, really the characteristics of a good candidate versus not a good candidate. So just to touch on that briefly, the characteristics of a good candidate, especially when you look at sectors, you need a company with strong, consistent cash flows, with a strong balance sheet, the ability to take on debt. So restaurants are going to be tough, right? Restaurants are cyclical, especially in the wake of COVID. I mean, I hope everyone out there that's a restaurant owner that's asking that question is doing okay today. I mean, it's been I'm sure, a very, very difficult 15 months. But the sectors that we see the most are manufacturing, construction, breweries are exploring ESOPs at a rapid rate. Healthcare transactions are exploding right now. Architectural, engineering. Really, the sector that we stay away from the most is probably technology. Sorry, Keith?
A lot of distribution companies as well, and a lot of the food space.
Yep, distribution, thank you. Really what we stay away from are technology companies. And we don't do that intentionally, but technology companies are typically trading at a multiple of earnings that an ESOP just can't compete with. An ESOP is going to compete with a private equity buyer. An ESOP is going to certainly compete with a strategic buyer on an after-tax sale. But it's really about finding the company that's going to be able to take on the debt at the company level, strong, consistent cash flows, and not a lot of existing debt on the balance sheet.
The other reason tech is tough, Joe, is technology companies oftentimes are trading on future earnings.
Yeah.
And with an ESOP, it's a tax efficient leverage buyout. You need strong, consistent, predictable cash flow. So tech hasn't really worked well.
That leads to this next question, which is what happens if a company takes a loss for a year? Or a lot of companies who maybe set this up in 2018, 2019, and now we went through the whole Corona experience and revenues dipped. How does that play out?
Yeah, so there's two things that come to mind there. Obviously, at the owner level, you at least sold your stock, so you can exhale a little bit in the cash at close that you received. You diversified your net worth. There's a little bit less stress on you and your family, for sure, knowing that you got a transaction done. But certainly, from a company's perspective, the tax savings at the corporate level are going to help you get through difficult times. Because if you think about the tax-free cash flow of an ESOP, it's almost double what it would be in the event that you were owned by an individual who had to pay close to 40% in income tax. Now, if you took a loss for a year, it's the same thing with a non-ESOP company. You have to manage it, right? If you took on debt at the company level and you had a loss and you were not an ESOP, you'd have to work with your bank. Talk about covenants, talk about what flexibility you had, talk about how lenient they can be. If you are an ESOP, fortunately, you don't have the same tax leakage. So obviously you can come out of that hole quicker, but it's important to have that level of relationship with the bank and to manage it the same way that you would manage it in a non-ESOP owned company.
Well, Nick and Keith, I can't begin to thank you enough for all that we've learned from you today. I mean, there are more questions, but we are unfortunately out of time. So I want to say thank you both very much for sharing your expertise. Everyone will get a link to the recording to this event, as well as the contact information for both Nick and Keith, and I'm quite confident they'd be more than happy to ask your questions. And with that, I'd like to say thank you again for helping us understand the value of an ESOP. You guys have been awesome, and we'll send that link to the recording and slides 24 hours. And with that, to all of our attendees, I hope you'll join us next week for the next Peak Performer webinar on marketing in a post-COVID world. We've got 3 of our very best marketing speakers joining us next week to talk about how you need to rethink how you connect with your clients and engage with your prospects as we now enter this economic surge that's going to carry us for the next 3 to 4 years. Register at vistage.com/webinar. That's vistage.com/webinar for next week's marketing in a post-COVID world. I'm Joe Galvin, your Chief Research Officer. I thank you for your time and attention and say, everyone, please stay safe. Thank you.